The ideal business is one that earns very high returns on capital and can keep using lots of capital at those high returns. I mean, that becomes a compounding machine.
Warren Buffett defines a compounding machine as a company that earns high return on capital. We're going to be looking at a new position in my portfolio that I think meets this criteria. I'm going to be outlining my buying strategy and why I think the company will produce high free cash flow over the next 5 to 10 years to be distributed to owners. Google is also at all-time highs. They report earnings in a few weeks. We're going to be going over some of the growth catalysts in 2026. If we come over to the new position, I decided to buy into a starter position in Netflix with hopes to cost average down with any more further volatility this year due to the pending acquisition of Warner Brothers Discovery. I'm going to be going over Netflix Moat, management's capital allocation performance, and why I think they will become increasingly profitable over time. In the same shareholder meeting that we just watched, Charlie Munger explains why high-quality businesses produce a lot of cash.
Take a business that is a good business but not a fabulous business. They tend to fall into two categories. One is the business where the whole reported profit just sits there in surplus cash at the end of the year, and you can take it out of the business, and the business will do just as well without it as it would if it stayed in the business. The second business is one that reports the 12% on capital, but there's never any cash. And there are an awful lot of businesses like that where just to keep going, to stay in place, there's never any cash. Now that business doesn't enable headquarters to drag out a lot of cash and invest it elsewhere. We hate that kind of a business.
If we come over to the second brain, I want to look at Netflix's management first. I want to look at how efficiently management can allocate capital. To do this, we're going to be looking at the return on invested capital and why calculating this number for Netflix is a little bit different than other companies. This will show us how much of profits need to be reinvested into the company in order to produce the future profits. On average, content costs have been around $15 billion for the last few years. So for the denominator of ROIC, I use the net operating assets. This is how much Netflix spent on content costs. Netflix then amortizes this content over its useful life, which in this case is 4 years. The other aspects of cost of capital have fluctuated in Netflix history due to one-time tax breaks, so I factored in a more normalized tax rate into the calculations. Coming down to the actual ROIC numbers for the last few years, I decided to not look at 2020 and 2021 because 2020 was an outlier because of COVID, and the ROIC number is inflated due to no production costs while revenue continued to grow. But I wanted to start in 2022 because this is when the stock was at a low point. Coming down to the ROIC numbers themselves, in 2022, Netflix attained 16.5% return on invested capital. This is when Netflix stock plummeted after 2 record years where ROIC was 20+% for 2020 and 2021. Management decided to crack down on password sharing and introduce the ad tier subscription, which were 2 levers for the business to increase monetization. This led to increased ROIC the following year in 2023. This is strong organic growth from the business. Looking forward to 2024, ROIC increased again to 30%. This shows that Netflix has achieved a self-reinforcing loop or flywheel. When it generates enough cash to fund the largest content budget in the world, which is around $15 billion a year, invest the profits from that $15 billion into new growth initiatives, which then increases its value for owners through repurchasing stock, returning money through dividends, or capital gains. Depending on what happens with the Warner Brothers merger, there might be more debt on the balance sheet. However, Netflix will be able to pay this down with relative ease. This will lead to Netflix being a cash-rich company over the long term that Charlie Munger described as a fabulous business. I pulled a few screenshots from management's comments in the Q3 letter to shareholders from 2025. I think looking at management's tone and the way that they talk about the business and operation is important to being aligned with management. As you can see, management focuses on revenue for growth and operating margins for profitability. This is what you want to hear from management because this is what will be accretive to us as shareholders. If they can sustain the healthy revenue growth, expand their operating margin, and deliver growing free cash flow, the company will be able to pay us large sums of money in the future. And you don't want this growth to be fueled by debt. This is why it's good to see management saying they want to prioritize profitable growth by reinvesting in the business. Through M&A, like what they're trying to do with Warner Brothers, while still having enough liquidity to sustain an economic downturn, as well as return excess cash to shareholders. Coming back over to the graph view, I want to look a little bit more at Netflix's moat. I think Netflix is one of the premier streaming assets in the world, and I think they're well positioned to continue to capitalize on the global shift away from legacy media and towards streaming services. Their top competitors being YouTube and Disney, but they also face competition from Peacock, Paramount, and other streaming services. You may have seen this pie chart before, but Netflix is only second to YouTube in total TV watch time. Netflix has continued to grow revenue at 10+% year over year and has now amassed over 300 million subscribers with multiple levers to continue to monetize them. Netflix has to reinvest capital into content costs on a quarterly basis, but as the top and bottom line increase, the gap between content costs and free cash flow should increase. This should position Netflix over the long term to compound EPS at a market-beating rate. Because of the uncertainty surrounding the Warner Brothers acquisition, the company's stock is down 30% from all-time highs. I'm not going to get into the numbers of the valuation too much in this video, but I do think the stock price is nearing a top-end range of valuations and to look to capitalize on any further dips in the stock price to build out my stake. I think ultimately Netflix's moat comes down to consumer stickiness. I think it's very unlikely that consumers cancel their Netflix subscriptions even in a severe economic downturn. As a consumer myself, I think about all the other things that I would cancel before I cancel a Netflix subscription. People want to be a part of these large cultural events and shows and things that are streamed on Netflix. In 2022, when the stock price was down, there were concerns that the total addressable market wasn't as big as previously thought. However, I think as Netflix continues to grow its content log and diversify into live streaming events, and as their ad business continues to scale, I think the total addressable market is large. Over time, the content moat will only get stronger as the volume and quality of the intellectual properties Netflix owns increases. This should increase subscriber retention with no additional production costs. This leads us to the Netflix Growth Catalyst note. This is only the third year the ads business has been operational. Ad revenues doubled in 2025 as Netflix has recently launched their own first-party ad tech stack. Management believes that they're well positioned to leverage all the data they get from their platform through advancements in AI. This will help the ad business overall in a variety of different ways. For example, better placement of ads, better show recommendations, and new ad formats. 65% of new subscribers are joining the ad tier. If subscriber growth continues to grow as it has, margins should expand because the ad tier subscription provides higher margin revenue than the base subscription, which costs more per month for users. In addition, I want to look at the content log itself and how Netflix amortizes their content. Over the first 4 years, 90% of content has been amortized. During the first 1 to 2 years, the percentage of the amortization is higher because this is when the majority of binge watching and when subscriber interest is the highest. Once a show or movie is fully amortized, its book value on the balance sheet is effectively zero. Any value it provides the business after that point has no corresponding amortization expense on the income statement. This fully amortized content earns revenue through increased subscriber retention, so subscribers will keep their subscription longer, also through ad revenue, because this content still has ads on it for subscribers that are watching it even after it's left the financial statements. Netflix also occasionally licenses their IPs to third parties. This isn't a big part of the business, however. And lastly, they can make money through merchandise for their popular IPs such as Stranger Things or Squid Games even after the initial production expense has been written off. Over time, not only will this strengthen Netflix's moat, but it will also strengthen their growth profile. If the Warner Brothers acquisition goes through, the strength of their IPs will increase substantially, and further levers for monetization will be realized. However, I don't want to base my thesis on the potential acquisition that might not make it through regulation. Lastly, if we come over to Google's growth profile for 2026, I briefly wanted to go over Gemini adoption and what that might look like moving forward. I have some data from January 2nd on overall market share and how it's changed over the course of 2025 and leading into 2026 between ChatGPT and Gemini. As you can see, Gemini has been taking market share from OpenAI over the last 12 months. So Gemini is this red block that's growing faster than any of the other large language models. And if we look further at the data, you can see that Gemini surpassed 20% market share, with ChatGPT dropping below 65%. Just 12 months ago, ChatGPT was at 87% market share, with Gemini just at 5.7%. And as you can see over time, ChatGPT has continually lost market share to Gemini, culminating in January 2nd with Gemini reaching 20%. I think Google will continue to integrate Gemini throughout all their products. This will further adoption and increase daily and monthly active users over 2026. Google is still waiting to monetize Gemini as they're focused on growing their user base before monetization. I agree with management's decision to focus on the user base instead of monetization. I think this shows a long-term disciplined approach to what will be a huge new revenue stream moving forward. The way that Google plans to monetize Gemini won't be through traditional banner ads like on Google Search, but will be more task-oriented than information-oriented, with ads popping up after Gemini has completed the task. I'm going to go over Google more in depth in future videos, but just wanted to cover a little bit about Gemini as I've seen the new data come out. It takes me a lot of time to record, research, and edit these videos, and I'd really appreciate it if you guys could like and subscribe. See you guys in the next portfolio update.